Hey everyone, and welcome. We need to talk about a massive policy shift that's heading our way, one that could seriously reshape Singapore's stock market. And the numbers involved? Well, they're absolutely staggering. Just look at this figure, $9 billion. A recent Citi report projects that this is the amount of new money that will start flowing into the Singapore market every single year starting in 2028. And we're not talking about a one-time thing here. This is a recurring tidal wave of capital, year after year after year. So a number like $9 billion, it just begs the question, right? With a change this huge on the horizon, who is actually going to benefit from this unprecedented cash injection? To figure that out, here's how we're going to break it all down. First, we'll unpack that $9 billion shockwave. Then we'll explain what this wall of money concept actually is. After that, we'll look at who's best positioned to soak up all that cash, walk through this strategic timeline, and wrap up with a reality check on some of the potential risks involved. All right, first things first, let's really get into this whole wall of money idea. It's a term you hear a lot, but what does it actually mean? Because it's not just about the sheer size of the check. It's about how that money is going to hit the market. And here's the key distinction. The thing that makes this so different, a wall of money isn't driven by hype or a bunch of people getting excited and piling into the market. No, this is structural. It's baked into a new policy, the CPF Life-Cycle Investment Scheme. That means it's predictable, and believe me, it is coming. And this is why it's such a game changer. Think about it. It's programmatic, which means it's on autopilot. It's non-discretionary, so fund managers have to invest this cash every single month, rain or shine, good news or bad. And what does all that add up to? A relentless one-way demand for stocks. That's what we mean by structural buy pressure. Okay, so we've established this massive force is heading our way. If you've got $9 billion that needs a home every single year, the obvious next question is, where on earth does it all go? Well, the answer really just comes down to simple market plumbing. Imagine you're a fund manager and you have to invest billions. You can't just go out and buy a bunch of small, thinly traded stocks. You'd send the price to the moon before you even finished your order. You need scale, you need liquidity, and that naturally pushes you toward the biggest, most traded companies out there, the real structural pillars of the Straits Times Index. And that leads us to some pretty logical candidates. You've got DBS, the undisputed heavyweights of the index. I mean, for any fund that's trying to track the market, it's pretty much a mandatory first buy. Then there's Singtel. It brings a bit of a growth story to the table with its focus on regional data centers, which is a great fit for younger CPF members' portfolios. And you can't forget Keppel. It's shifting to manage real assets, which is exactly the kind of inflation-proof investment that big institutions are always looking for. So what's the big picture effect of all this? Well, it could lead to what's called a market re-rating. Basically, think about it. Billions are going to be moving from super safe 2.5% CPF accounts into these blue chip stocks. Over time, that could change how we even define a safe investment. These companies might start to be seen as retirement-grade assets, and if that happens, investors could be willing to pay a permanently higher price for them. Okay, so you might be thinking, 2028, that's ages away. Why worry about it now? But here's the thing. The market never waits. It's always looking ahead. The so-called smart money is already figuring this out and getting positioned for it today. So if we look at the path to 2028, we can see what's happening. Right now, the market's getting a boost from another government program, the Equity Market Development Program, or EQDP. But that's expected to be fully deployed by 2027, which could create this interesting little lull, maybe a liquidity gap. That's the transition window that sharp investors are really paying attention to, right before that $9 billion annual flow really kicks into gear. But look, it's not all smooth sailing. Of course not. While this wall of money is a huge long-term tailwind, in the short term, there are some very real headwinds we have to be honest about. Take the whole higher for longer interest rate situation we're in. For a bank like DBS, it's a classic double-edged sword. On one hand, hey, higher rates mean they make more money on their loans. Great for profit margins. But on the flip side, those same high rates put a squeeze on the economy and increase the risk of loan defaults. So it's a real balancing act. And beyond just interest rates, you've got other things to worry about. Geopolitical friction, for one. Companies like Singtel and Keppel have huge operations all over the region, so they're definitely exposed to any trade tensions. And then there's what you might call the exit ramp risk. What if big foreign funds see all this guaranteed local buying as the perfect opportunity to sell their own positions and take profits? That could definitely put a damper on price increases. Ultimately, this shift represents the institutionalization of Singaporean wealth.
For long-term investors, that wall of money creates a very strong case for holding these market leaders, even if the path toward 2028 feels a bit bumpy in the short term. It's a fundamental change, and one that is definitely worth watching very, very closely.